Hello friends, good evening. Today I come up with one topic called Basel Accord. Before we will discuss about the Basel Accord, we must know the consequences or the reasons for evaluation of Basel Accord. In the 1974, because of differences in the time zones, the settlement risk was evolved, and because of that settlement risk, the banks are collapsed. That is called Herstatt risk. Because of that Herstatt risk, some of the bank heads combined together and they designed an accord at a place called Basel. That accord will moderate step by step, and now Basel III norms all banks are using on today. Before discussing about the Basel III norms, we must know about the Basel Accord. The Basel Accord is mainly to protect the banking system during any unforeseen events may happen. In the Basel Accord, basically it consisting of three-pillared approach. One is a minimum capital requirement. The second pillar is supervisory review process, and the third one market discipline. These are the three pillars. Based on these three pillars only, the Basel Accord presently we are using. In those three pillars, now we will see what is the first pillar, minimum capital requirement. The minimum capital requirement is nothing but the Basel Accord specifies that if any bank want to continue their business operations, they must maintain the minimum capital requirement which is specified in the accord. So, we have already discussed in the previous class about how the capital is divided into categories. At the same time, based on the division of the capital, the minimum capital requirement for any bank, Basel defined a formula, that is, the minimum capital requirement for a bank is equal to minimum capital requirement for credit risk plus minimum capital requirement for operational risk plus minimum capital requirement for market risk. So, if you are in a position to calculate the minimum capital requirement for credit risk as well as operational risk as well as market risk, then if you summation of all these capital charges, then you will get the minimum capital requirement for a bank. See, this is the first pillar. Now, most of the problems and most of the concepts are relay basically on the first pillar of Basel Accord, the minimum capital requirement. Out of this, today we will discuss about the minimum capital requirement for credit risk. In the next classes, we will discuss about the minimum capital requirement for operational risk as well as market risk. Now, let us enter into minimum capital requirement for credit risk. Let's discuss about what's a credit risk. The credit risk is nothing but an amount as a loan to a borrower. If he may default, what kind of risk it is? It's a credit risk. And that credit risk can be divided into a lot of categories. That's a different issue. But broadly, I am specifying that credit risk is nothing but your asset may not be acquired by you. That means, in the layman's language, what kind of risk we will face if all these accounts will become an NPA. nothing but basically a credit risk. See, in order to discuss about the minimum capital requirement for credit risk, we must discuss about how to calculate capital charge for credit risk. Because how much charge, how much portion of capital must be set aside for credit risk exposure. So, capital charge for credit risk can be calculated by two methods. One is standardized approach and the next one is internal rating based approach. Now we will see about what is this standardized approach. Is nothing but it is a methodology to estimate how much capital need to be put aside to mitigate credit risk. Under this standardized approach, guys, please be remember, it uses the assessment based on the external credit rating agencies. Whatever the assessment done by the external credit rating agencies, this standardized approach methodology takes those as inputs for calculation of risk weights. Based on that, we can easily calculate the capital charge. So, what is this external credit rating agencies? Some of the examples for external credit rating agencies: CRISIL, ICRA, SMERA, Brickwork. These are all different external credit rating agencies. This specifies some rating. Based on that rating, under the standardized approach, the bank has to assign a risk weight. For example, if a rating of a bond is AAA, then the risk weight will be 100. That's under the standardized approach. Here, if the rating is good, then the risk weight will be very less under the standardized approach. And under the standardized approach, the risk weight for cash balances is 0. And under the standardized approach, the risk weight for housing loans which are below 25 lakhs is of 75% only. And under the standardized approach, the retail segment, entire retail segment can be assigned with the same risk weight irrespective of the type of loan. For example, the vehicle loan as well as the housing loan both charges a risk weight of 75% only, even though the risk is differ from one type of loan to another type of loan. And in this approach, if an account becomes NPA, then if you are maintaining a 20% provision for that account, then you need to assign a risk weight of 150%. If the provision is in between 20 to 50%, the provision will be 100%. If the provision is less than 50%, then the risk weight will be 50%. These are the inputs we are following while calculating capital charge with the help of standardized approach. Guys, with this you can easily understood that the risk weights assigned is not an individual perception. It is based on entire exposure based risk weights. Under the standardized approach, commercial real estate weights 100% risk weight. If it is a mortgage loan, or if it is a housing loan, or if it is a vehicle loan, whatever the loan it is, the risk weight is 75%. Under the standardized approach, retail segment is differentiated from SME exposures. These are the basic inputs of the standardized approach. But guys, in the banks, we didn't use standardized approach in any bank. Later, there is another approach was designed to calculate the capital charge for credit risk. That is internal rating based approach. Internal rating based approach is of two categories. One is internal rating based approach foundation. Another one is internal rating based approach advanced. Before discussing these two approaches, we must know what exactly the internal rating based approach. In this internal rating based approach, unlike standardized approach, bank has designed their own set of risk parameters, internal risk parameters. Based on that internal risk rating only, we must calculate how much capital is required to charge to mitigate the credit risk. See, in this internal rating based approach, banks didn't rely on external credit rating agencies. They designed their own rating models. Please be observed, guys, in all these banks we are using a risk rating model. Some banks they are using CRRM, CRM, CRS, CRAS. Some banks they are using IRB approach, internal rating based approach, obligor rating. These are the different terminologies we will come across. We are come across day by day and every day. See, these are all nothing but all the banks are using internal rating based approach only. Under this internal rating based approach, the inputs are supplied by the bank or a supervisor. Who is that supervisor? Supervisor is nothing but who is going to continuously examine the bank policy guidelines. He is nothing but a supervisor. The inputs may be provided either by the bank or by the supervisor. Based on the provider of the inputs, the approaches are divided into two categories. One is foundation based approach and another one is advanced internal risk based approach. Before discuss these two approaches, what kind of parameters we are examining in this internal rating based approach? We are using 4 parameters to calculate the capital charge for credit risk based on internal rating based approach. One is PD, probability of default, PD, and the second one is LGD, loss given default, and the third one is EAD, exposure at default, and the fourth one is maturity. Basing on these 4 parameters, we are going to calculate how much capital charge is required to mitigate the credit risk under internal rating based approach. Now we will see the terms one by one. Probability at default. What is it exactly? Suppose you have disbursed a loan of rupees 20 lakhs to a customer. Then what is the probability to become that borrower as a defaulter to the bank? The calculation of that one is nothing but PD, probability of default. Further, we need a historical data of that particular borrower. Based on that, we can come to conclusion that whether is there any chances to become a defaulter or not. If there is a chances, how much percentage the chance. So this can be calculated with the historical data. This is about the probability of default. And the next one, loss given default. As a whole, bank, what kind of or how much amount of loss we are going to incur if there is a credit risk happened in the bank. So that is called loss given default. If an account becomes NPA and if he will become a defaulter to the bank, then how much amount of loss a bank can incur, that can be specified with the help of a parameter called loss given default. And the next one, exposure at default. Suppose if a subprime crisis type of crisis may happen in any kind of bank, or if any falling of a share market, or if any downtrend in any kind of sector, then some of the sectors will definitely get affected. If banks may finance to those kind of sectors, definitely banks are under a risk position. For example, some of the states, there is a problem with the power plants. Most of the banks, they have financed to power plants, but now their power plants are in the risk zone. So there is a risk, there is a threat to the bank. So that is called, if an exposure, if an industry, if a one type of industry may not running well, that shows a negative impact on the exposure of that particular limits of the bank. So that can be calculated with the help of EAD, exposure at default. And next one, maturity. How long an account will be in active state, that means in a non-defaulter position, that can be assessed with the help of a tool called maturity. So with these four internal parameters, only a rating methodology is developed by individual banks itself. That is called internal rating based approach. Then who will provide this data? The history of losses, the history of defaulters, the history of exposures which are under a great crisis. These are all given by either two persons, either a bank or a supervisor. Who is the supervisor? Supervisor is nothing but who is going to supervise the loan policy guidelines of the bank and the credit structure of the bank. Nothing but our RBI. See, based on these data inputs provided by the entities, the internal rating based approach is divided into two categories. One is foundation based approach and next one is advanced internal rating based approach. The foundation based approach, only probability of default can be provided by the bank and remaining things the data inputs provided by the supervisor itself. Whereas in the case of advanced internal rating based approach, all the data are provided by the bank itself only. This is the basic difference between advanced and foundation based IRB approaches. I think it's very clear about standardized approach and internal rating based approach. In the next class, we will discuss about the capital charge for market risk. There are a lot of problems will come, numerical problems which are more essential in the BFM paper of CAIIB. Those can be discussed in the next class. Please subscribe to my channel. Thank you.